Well, J-Pow just flipped. This is wild. We just potentially got Powell telling us that he's turning the vacuum cleaner off. And let's just say he gave some hints as to why he's turning the vacuum cleaner off. So let's get into that. Note this video is going to be sponsored by Investing Pro because they've got their Pro Plus flash sale going. If you use that coupon code, you not only get the 50% off that they have on their website now, but you also get the extra 15% off. More on them later, though. Let's focus right now on Powie Wowie, what was just said. Okay, so first of all, as expected, when we put together our bingo board, we thought that Powell was going to talk down the fact that we're not getting labor market data. We actually wrote here that he would downplay the BLS data, that we have other data that we can get to, and that the labor market's not falling off a cliff, and that we're on a wait and see. We're not getting a rug pull. We want to get closer to neutral. A lot of this pretty basic. You know, we've seen a lot of that so far. And this reiteration that we're in a low hire, low fire market, we've heard of this before. But what was new here was that Powell came out and spent the first maybe 10 minutes talking about the balance sheet. Now, to understand the balance sheet, I want you to think about the money printer days, okay? So think about this as simply as possible. Oh no, the economy's in the pooper. Bring out the money printer. You run the money printer. Basically, what you're doing is you're growing the balance sheet, okay? You're printing money, and the way you print money is you just digitally go into a spreadsheet and you go, well, we were at 6 trillion, let's just change the number to 9 trillion. So you literally just change the number on the spreadsheet. And all of a sudden, out of thin air, you've created $3 trillion. And then you go, here you go, Congress, go shower the economy with money and save the world. That's basically money printing in a nutshell. That has now substantially increased the Federal Reserve's balance sheet. Now the Federal Reserve is interested in reducing the balance sheet, which they've been doing since 2020. They're like, we've gone too much. We're reducing the balance sheet. Now the Fed is talking about no longer reducing the balance sheet. So think about increasing the balance sheet, running the money printer. Think about reducing the balance sheet as vacuuming. So you're like, we put too much money. Going around sucking money back out of the economy. You're absorbing by basically saying, hey, we're gonna sell bonds, we're gonna take money out of the economy, and we're gonna try to use that as a tool to restrict. Well, now Jay Powell's like, done a lot of vacuuming. We're just gonna go over here and go, click. So in the coming months, he's going to turn off the vacuum cleaner. Okay, well, what does that practically do for us? Like, what's the trade, bro? Kevin, just tell me, what's the trade? When you turn the vacuum cleaner off, what you're really doing is you're saying, okay, we are going to go and no longer put this pressure on the treasuries market, which could mean that we might end up seeing yields actually start coming down, which is nice. We might also see, because remember, the whole point of vacuuming up money is to increase market rates. And if you increase market rates, you're basically tightening to try to control inflation. You say, all right, we've done enough vacuum cleaning. You stop doing that. You stop sucking money out of the economy. You stop selling those bonds. By selling bonds, what you're really doing is you're increasing the supply of them. I know that gets a little bit complicated. You increase the supply of them, the price goes down, yields go up, right? You stop doing that, you actually let yields come down. So bottom line, I know that gets complicated. When the vacuum cleaner turns off, yields get to start falling. Now, he told you which part of the curve. He literally told us which part of the curve. Now, you could use this obviously in your investing by going to investing.com and using the Investing Pro coupon code to join. It's that time of year again where investing.com is running their flash sale. And in this, I'm going to show you why I'm so excited by the features that investing.com offers and why you might want to consider using that coupon code linked below, because investing.com is running their flash sale, offering up to 50% off on Investing Pro and Investing Pro Plus plans. But here's the really exciting part. if you use my code MEETKEVIN, you'll get an exclusive extra 15% off for a total discount that's even higher than what you're going to see on the website. So click the link below to claim your subscription and start using Investing Pro or Investing Pro Plus today. This is special only for a limited time during this flash sale. Now, here's what I love about Investing Pro, and it's exactly why I'm willing to throw up on screen with my face right next to it, the flash sale banner. Okay, no, really, why? Let's say I need to sound smart and go on CNBC really quickly and do an analysis on a stock that seems undervalued. And I didn't do my homework. And I'm like, oh my gosh, I gotta go do something really quick. Look at this. Oh, whew. Investing Pro's got my back. They've got undervalued stocks, overvalued stocks, 52-week high, 52-week low. Let's find something on the most undervalued stock. Here's one I recognize. Adobe, okay? Adobe Systems. 33% upside. Interesting. So if I click on it and I go into the Investing Pro side, there's some really cool things I'm going to get here. First of all, if I just want a quick PDF to read on my iPad and annotate, I'm going to click the Adobe Pro Research button and boom, I'm going to get a beautifully assembled PDF on this company. I mean, look at some of the things it immediately tells me. Downsides, doesn't pay dividends, moderate level of debt, high price to book multiple. Honestly, I don't even care about that. It's a SaaS company. Who cares about the book value? It doesn't matter. It's not like it's a real estate company. What do we got on the other side? Impressive gross profit margins. We've got management that's been buying back shares, and we've got a relatively low volatile stock. Now, one of the reasons it's a little on the low volatile side is because right now the technicals suck. And I didn't have to adjust or determine that. I just had to look at the PDF. It says strong sell on the technical indicators, which does suggest there could be continued downside. And boy, oh boy, when you look at the sticks, yeah, it does look like we's on a downtrend. But this is what I love, because now as an analyst, I can also get 10 years worth of forecasts on earnings per share growth. You know me, I like doing PEG ratios. I like taking earnings and dividing it by the average forecast of years of growth for earnings per share. And many of you have been asking, Kevin, where can you get this data? And I've never really had a good answer other than paying like $30,000 a year for these crazy like Wall Street subscriptions, which is kind of a crap answer. And so finally, I've got a great answer, and it's today's sponsor. You get the Investing Pro Plus subscription, and you could get, for any of these companies you're looking for, or you could get forward EPS guidance if you have the Investing Pro Plus subscription. Now, of course, I don't cover every single stock, but a lot of the stocks that we're looking at on a daily basis, they've got incredible forecast sets, and I highly encourage you check it out. Give them a try. Use the link down below. Get the 50% off. Use coupon code MEETKEVIN and get an extra 15% off. And check out that investing.com Pro Plus subscription. Make sure you check out earnings per share. Make sure you check out the analysis they have, because they're great sponsor of the channel. But he told us, Jay Powell specifically told us which bonds. He said, ideally, we want no mortgage-backed securities in the future, so they want to get rid of all of those. Once they're done with those, they're not interested in MBSs. All they want are treasuries. And they said that right now they are overweight longer-term treasuries and underweight shorter-term. This means that once we kind of get rid of the rest of these longer-term treasuries, that's where you might see some of the biggest shift by turning off the vacuum cleaner, which is probably bullish long-term rates coming down, bullish mortgage rates coming down, the 10 to 25 year end of the curve probably coming down. Now, why would Jerome Powell do that? Why turn bullish here, or should I say dovish? This was more dovish, right? Which is bullish in the short term for the stock market. In fact, that's what we wrote over here. I actually originally thought we were going to get a neutral Powell and that we would end up getting yields up. But what we actually got was a dovish Powell. And we thought, okay, but if we get a dovish Powell, then we will end up seeing yields come down, which is what we're seeing. Now, what does this mean? Why is he going dovish? Well, one of the reasons he's going dovish, he was asked about at the end, is because he says we might now be at the point where the beverage curve is normalizing. Now, this is another complicated one to understand. I'm going to keep this as simple as possible. Because if you're not familiar with the beverage curve, you're like, okay, what are we talking about? Like Coca-Cola or Pepsi or like, what's the play here, man? I don't understand. Look, this is very simple. This chart is the normal version of this chart, the non-perverted version of this chart. It's basically how it normally operates and has operated for the last 40 years. Okay? Something very odd has happened recently, though, with this chart. And if you look at the chart, I'm going to throw these little stars over here. The vacancy rate has plummeted. So we've started putting a bunch of dots basically where these stars are. And this is what Powell said when he goes, yeah, beverage curve, that's gone straight down. He says we've been fortunate of that, but we may now be at a place where the unemployment rate starts going up. That turning point may be now. Okay, that's bad, because what this means is if you normalize this curve and you start getting data that pushes you this way, which is the normal path of the curve, then data points start coming out along this way of the curve, and the unemployment rate's gonna skyrocket to 10 to 15% rapidly. And he says we may now be at that turning point. So think about this. He's actually being mega dovish here without saying, hey, we're gonna rapidly cut a bunch of, we'll do a bunch of rate cuts. He's telling you, yeah, we're turning off the money vacuum because we need to start stimulating the economy because we have serious risks here on the labor market. On the other hand, he's like, we don't want to send the signal that we're going to cut rates really rapidly because that's going to mess with people's inflation psychology, which he was also worried about. He's like, look, most of the pricing pressures right now are coming from tariffs. He says structural inflation, very, very low right now. Most of the pressures are from tariffs. So think about what he's doing, okay? There are 3 prongs to what Powell is doing here. 3 prongs. All 3 of the prongs tell you should join the Meet Kevin membership. Oh, that's a funky little video there, isn't it? Because you got like 2 pictures of me on top of each other. Let's go with it. Okay, join the Meet Kevin membership. People say the ad goes away once you join. Potentially tax deduction. You get our trading strategies every day, short, medium, long term. Top 10 stocks to buy for the next 10 years. You see when I start trimming NVIDIA stock or selling NVIDIA stock in this crazy AI bubble that we're in, and would love to have you in the membership. Anyway, no, the 3 prongs that we just saw from Powell, think about this. 3 things he just did. All of them point in the same direction. He told us, 1, beverage curve normalization is upon us. That's part 1, okay? Part 2, he tells us that inflation from tariffs is the remaining inflation, but normal, like structural inflation, not present. Only tariff inflation, basically, okay? That's prong 1. So prong 1 is beverage curve normalization may be starting, okay? That's a red flag, okay? This is important. Red flag for recession. You get a normalization of the beverage curve, we will be in a recession faster than you can blink. He actually also told us, which is very interesting, he actually said that the first thing to slow with rates is purchasing. Labor takes much longer. That's the long and variable lag portion, right? Okay. Number 2, structural inflation is not present, only tariff inflation, which again, all of these reiterates support jobs, okay? Reiterates dovishness. Only tariff inflation. What does that do? Support jobs, dovish, okay? Then the third one. So beverage curve normalization, we got that. We got structural inflation, not present. And then, obviously, we got his argument that very clearly we are seeing a desire to get back to neutral. So, back to neutral, support weakening labor market, which is somewhat is reiterated by the beverage curve anyway. But pull all of this together, this shows up. How do you do this? Balance sheet runoff stopping. That's probably the better way to put number 3, right? Balance sheet runoff stopping is basically to support jobs. It's actionably dovish. Like, this is not Powell being verbally dovish. It's him literally saying, hey, we're about to take action to stimulate because the jobs market is starting to show serious signs of issues. He's discounting the BLS data for now, saying we have other data we can get our hands on. But he also says, hey, we're about to miss out on a lot of data. Like, we're about to walk into, and this is where the Bureau of Labor Statistics came out with, Bloomberg was reporting on the BLS this morning. They actually wrote that the September report will be very important. We might not get it, though. The October's report will be missing starting if the government shuts down is still shut down in about a week from now. So if we're still shut down next week at this time, which we probably will be, we're going to start screwing up the employment survey and the payroll survey for October. Remember, the government shut down on October 1st, so we probably had a lot of our surveys already sent for the September data. And a lot of that data is probably bad because it would show the Doge layoffs and the voluntary dismissals. Those were supposed to show up in the September report. Now, we would have adjusted for that. We would have added that back in. But, we expect the break-even rates basically 0 to 20,000. So what if the labor report showed negative 50 and 50 of those were, from the government, the voluntary departures? Okay, add that back in, you're at 0. So maybe you're right at break-even, unemployment rate doesn't really change, right? Fine. But what if it was negative 100K? I don't know. It's maybe Donald Trump purposefully doesn't want these job reports out. I mean, he wants CPI report out because he wants the COLA adjustment for 69 million voters who are receiving retirement benefits like Social Security. And Donald Trump, scores really well amongst older voters. So of course he wants them to get their cost of living adjustments for Social Security payments, so he brings the CPI report back. Why does he? Then he obviously has the power to bring the same damn people back to give us the jobs report. But why would he do that? That would just make him look bad. So leave that part of the government shut down. Little manipulative, right? But that's exactly what's happening right now. So as a result, Powell's like, we know the data is probably bad. He's like, not only can we look at state unemployment claims, but we can also look at ADP data. Now, in fairness, he said so far, data on the economy and GDP are actually stronger, maybe just as firm as what we had at the last meeting. But he does make it clear that, hey, we could look at other data. Look at ADP, for example. And what happened with ADP? ADP at the beginning of this month, we were expecting 51,000. The prior read was 54,000. Remember what we got? Negative 32,000. And then it's like, oh, but what if you add back in the 40,000 adjustment? Add them back in. You're still at 8 to 14,000 jobs. That's a terrible ADP report. So it's not a surprise. If you actually break down what Jay Powell just did, he actually just turned dovish. Now, it's probably going to take a while for the market to digest all this stuff. But Powell turning dovish is exactly what they should do to avoid being too late. Powell doesn't want to be Mr. Too Late. So consider that. Again, the three big components here. Number one, we're turning the vacuum cleaner. Well, number one is the beverage curve normalization. We could be at that point. That's really dovish. It's like, we're at the turning point. Two, structural inflation isn't present. It's only tariff inflation, which they've said they're going to look at that as sort of like a one-time occurrence, not necessarily at one point, but over time and then one time. And then that's dovish, right? Because you're not worried about inflation as much. And then, of course, balance sheet runoff, stopping soon, turning the vacuum cleaner off. That's huge. So all of these things are dovish. This is a massive dovish flip from Powell. And it's potentially a game changer for, what we're going to do in the Alpha report in terms of our top 10 stocks for the next 10 years. We've got 6 of them are posted. Stocks 7, 8, 9, and 10 are coming out soon in the Me Kevin membership in the Alpha report. And then, of course, check out the sponsor, investing.com. Use that coupon code MeKevin. And you could use coupon code Schumer Siesta.
Coupon linked below.
To join us in the Me Kevin membership. But let me just make sure I didn't miss anything here on Powell, and I'll look at some of your comments here. Somebody says, do you think that rates will go down 50 basis points? No, because they don't want inflation expectations to get screwed up. So if you actually look at Wall Street, you'll find that currently we are pricing in a 96.7% chance of a cut October 29th and a 98.4% chance of another cut December 10th. So we are pricing in a full 2 rate cuts. But everything that we've seen here is broadly bullish on yields coming down. Now, is that potentially recessionary because Powell's waking up? Sure. That's the struggle that we're going to have to balance out with the stocks. That's where we have to look at it and go, all right, well, if we are about to have the normalization of the beverage curve, the unemployment rate pops up, and then we go look at like Salesforce to show us earnings on Agentforce AI, which is like a scam in my opinion. Oopsies, that might not be a very good bucket to reach into. It's sort of like, hey guys, everything's fine. We have this AI bucket. We have all this AI bucket of revenue. And then all of a sudden, unemployment rate starts skyrocketing because the beverage curve normalizes, just like it always does in history. And it's like, it's okay. Look at all this money we're making from AI. Oh, shit. The whole thing has no legs. The whole thing implodes then. So it's no surprise that gold is doing what it's doing. I mean, look at gold in the last year. That is like a double on gold. When does gold return a double, dude? In a year? That's crazy. It's not quite a double, but it's pretty shocking. Somebody says, just curious, employers lay off, continuous and high profits, strict immigration enforcement, stock market pushes up, inflation, government shutdown with better. I'm not really sure if you're asking a question though. That was a really good list though. So somebody asked, will that put pressure on the leverage side? Well, I mean, look, you should already have your debt warnings from what you saw Friday. Like triple and double leveraged ETFs will probably go bankrupt in the next downturn. But we literally saw, last week an inverse AMD triple leveraged ETF went bankrupt, evaporated, and you're going to see more of that. The next debt cycle, it's going to be crazy. It's going to be crazy. So somebody here writes, technology isn't showing up in productivity numbers yet. No, the reason for that, and I wrote that down too, one of the reasons you may not actually see, I'm going to explain this, okay? So if you're still with me here, good for you. You're going to get some extra insight here. So the question is, why are we not seeing some of this AI stuff show up in our productivity? Okay, let me give you the most simple explanation as to why you're not seeing AI in productivity numbers. AI in productivity numbers, okay? So let's make an example of how this is done, okay? So widgets produced equals 100 per hour, okay? Demand for widgets is 1,000, let's just say, okay? And let's say AI makes it so, well, let's put it this way. Let's say to do this, we need 2 guys working 5 hours to do this, all right? To make this happen. Let's say AI makes it so that one guy can do 100 widgets or, can do 1,000 in 5 hours, right? That one guy's productivity doubled. Company output stayed the same. Company costs on labor halved in this example, right? This could be like shipping software. It doesn't really matter what it is. All right, so the company costs halved, but the company output stayed the same. So did net productivity change? Did net productivity change economically? No. The output is the same. Okay, the output is still the same, except who won? Who won? The corporation won by spending less money. Revenue didn't go up necessarily because of AI. And that's like whether you call this a widget or you call it a service or whatever, this is what you logically have to think about. Is artificial intelligence going to change how many emails we can send per hour? Yes. Is it going to change how efficient we are? Yes. Is it going to change demand for our goods and services? Not necessarily. That's the problem. So AI might change the costs of the corporation and how much money they can earn, but it does not necessarily mean that their revenues or their ability to sell goods and services is all of a sudden now blowing up. So that's a downside for labor. You increase corporate costs and improve efficiency, but that does not automatically increase demand or total economic output. So basically, aggregate productivity growth doesn't actually show those efficiency gains. So when Powell's like, yeah, we're not seeing AI show up in the productivity stuff, well, duh. And this is what people forget about artificial intelligence. Is let me just give you, I'm gonna leave you with a basic example, okay? Let's say you go, hey, I'm an attorney and I've got 10 customers who need a trust drawn up, okay? 2 years ago, or 3 years ago, I'd have to have 3 interns or paralegals drafting these trust documents, and then I have to proofread them, and then it goes back to them, and grammar errors and spelling and all this bullcrap. 3 years ago, I need myself and 3 people to do my 10 trust documents for clients, okay? Today, I could go, all y'all paralegals are fired. And then I could go, GPT Pro, make trust document for those 10 people. Then I read it with my lawyer hat and give my professional opinion on top of that. That's why people hire the attorneys still. Because the attorneys are using GPT as well, right? But then they add, we need to put this clause in. You know, it's that extra 10% that you're paying the attorney for, right? So they put their little 10% on. Does that mean the attorney has more than 10 clients to service? Well, not necessarily. Now, technically, the attorney now has more money available. What could they do with that more money? Well, maybe they can go run more ads. But then the question is, even if that attorney has more money to run more ads, are there more than 10 customers right now who need those trust documents? Because if every attorney is now running 10% more ads, people are saturated with 10% more ads, they feel like they have more choice. Does it actually mean more customers for that attorney? Not necessarily. They might be spending more ad money just to stay par. But again, that attorney's net income is higher because they spend less money on that entry-level labor. Look, this is just coming from experience. We saw exactly this over the last 2 or 3 years at HouseHack. We're like, wow, we could do the same amount of work with half the staff or less than half of the staff. And we're like, damn. So we're looking at it as a corporation going, oh man, this is great for our shareholders because earnings per share is gonna go way up. And we're like, this is great. You know, does that mean the company is more productive? Well, obviously, I think the company is growing and being very productive. But I was just saying, on net, does it actually mean a company is more productive? No, we're getting the same done with less, which is great for corporations, great for shareholders, not great for labor. And that's why Powell is probably flipping a little dovish here. So in the short term, it's actually great for markets. Because in the short term, the market's just going to look at it and go, damn, Powell dovish? The punch bowl's still rich and full of booze. Let's keep the party going. Obviously, we're probably going to walk off a cliff at some point, but I mean, for now, this is great. This is bullish. This is fantastic. And you know what else is fantastic?
Kevin's somebody we consider. Kevin is fantastic.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.